Okay, welcome back, everybody. Hope you had a great break. I am so happy to introduce our next instructor, Suzanne Elliott. Suzanne began her employment with the Louisiana Legislative Auditor in 1991 in the Financial Audit Services section. Prior to joining LLA, she was employed as an auditor by private CPA firms in Michigan and Colorado. Excuse me. Suzanne has worked on the audits of numerous state and local government agencies, including the state of Louisiana's annual comprehensive financial report. In 2002, Suzanne became engagement manager in local government services section of LLA. In her 14 years in this position, Suzanne oversaw the approval and processing of engagements and reports of the local government and quasi-public agencies for which LLA has oversight. Suzanne currently serves as LLA's Quality Assurance and Research Manager. In this position, she oversees quality control for the LLA as a whole, coordinates LLA's peer review, performs quality control reviews of the audits submitted to the LLA by CPA firms, and works on special projects such as the revision and reorganization of the Louisiana Governmental Audit Guide. Suzanne is a native of Tulsa, Oklahoma, and she graduated in 1988 from Central Michigan University with a Bachelor of Science in Business Administration, accounting major. She is a member of the AICPA and the LCPA. Please welcome Ms. Suzanne Elliott.
Good morning, everybody. It is my pleasure to be here this morning to talk to you about resolving common audit findings. I hope to tell you today, these are the things we will discuss. Why do auditors write findings? What's the thought process that they go through to write a finding and to determine whether or not that finding goes in a report? The different types of audit findings, how to resolve common audit findings, and resources for resolving audit findings. Before we get to that, though, I want to talk about the accounting profession in general. I've been a CPA for more than 30 years, and the accounting profession has been very good to me. I'm very proud to be an accountant and a CPA. The accounting profession has traditionally been among the most respected of professions, and it's not hard to see why. Accountants prepare tax returns, they balance our books, they perform our audits. They do things that either we don't have the ability to do or that, quite frankly, we don't want to do. And that's always a valuable person to have in your corner. Accountants in general have the reputation of being trustworthy, responsible, and reliable. Sort of like this guy, Clark Kent, turning into Superman. Of course, Clark Kent was not an accountant. He was a mild-mannered reporter for the Daily Planet newspaper, but he did have the geeky glasses. He had the button-down shirt until trouble was afoot. And then he would find a telephone booth somewhere and he would rip off the shirt, lose the glasses, and become a champion of truth, justice, and the American way. Really good person to have in a foxhole if you happen to be in a foxhole. However, when things are going well, it's easy to think of your accountant as Superman or Wonder Woman. However, when accountants are bearers of bad news, it's kind of shifts into a different situation. Accountants are the ones who, they'll do our tax returns and they may have to tell us that they owe a lot of money to the IRS. They may do our books and they tell us we may owe money to the IRS, but we don't have any money to pay to the IRS, and that we've got 10 findings in our audit report. When that happens, the perception of the accountant can go from Superman to this guy here. I don't know if any of you saw the movie Ghostbusters in the 80s. This is Louis Tully. He was the accountant in Ghostbusters. He was a lovable guy, little clueless, but in Louis embodied all the negative stereotypes of accountants since there were accountants. Louis was inordinately obsessed with his bottom line. He gave a party and he bragged to the people at the party that he was able to write the party off on his taxes because he invited clients rather than friends. He he liked to give a lot of unsolicited advice, and he was obsessed with rules and regulations. He's the kind of person who would read a manual on a coffee maker and memorize it, which is, great if you need to know how many scoops of coffee you need to put in your Mr. Coffee filter, but generally speaking, not the kind of person you want in a foxhole with you. And when auditors have to write findings, it's understandable that the perception of the local government toward their accountant might change from Superman or Wonder Woman to Louis Tully, because local governments don't like findings. Nobody likes to be told they've done something wrong. I don't like to be told I've done something wrong. Especially no one likes for their bosses, their oversight bodies, and the public to know they've done something wrong. And if you're a local government, you have to answer to all of those people. However, even if a finding is justified, it's kind of helpful and convenient to fall on the perceptions of auditors, the negative perceptions of auditors as to why the finding is written. One of the perceptions is that sometimes auditors write findings to justify an increase in their fees. And I can tell you from my experience in public accounting and from my experience talking to CPAs in public accounting in Louisiana, the reality is that, like any other professional, auditors do charge an hourly fee for their services, but contracts for local government audit services in Louisiana are required to include a not to exceed amount. It takes a long time to perform an audit in accordance with all the standards an auditor is required to follow. And it also takes a long time to write a coherent, concise finding with all the elements required by the auditing standards. CPAs tend to be very good at spreadsheets. They tend to be good at analysis. They tend to be good with numbers, but most of them are not naturally gifted writers. The not to exceed amount may be increased for cause, and it certainly can be increased if there's a lot of findings that the auditor was not expecting. But the auditor has to get the local government's approval to increase the fees. And it's not uncommon for an auditor to eat all or part of the extra time they spend on an engagement rather than bill the client for it. It's just easier, especially if it might cause hard feelings from the client's side. So most auditors don't look at findings as a way to increase their fees. Another perception is that auditors write findings because they like to tell people they've done something wrong. And the reality is no one likes to be told they've done something wrong. But for most people, it's not much better to be in the position of having to tell someone they've done something wrong. I can speak from experience on this. There's often the question in the back of an auditor's mind that they could be wrong. In my current job, I review reports that the legislative auditor is about to issue. And a couple of weeks ago, I reviewed a report, and there were a few little problems I saw in it. But I looked at the report, I looked at the issue that I was seeing, I read it 2 or 3 times. I went back to the source documents and looked and made sure that I was seeing what I was seeing. I went back and forth 10 or 15 times before I went to the director and said, I think that this is a problem, not a big problem, but it needs to be corrected. And it turned out I was right. But there's often the question in the back of an auditor's mind that they could be wrong. Findings often create tension between the local government and the auditor and can cost the auditor future work with the government. Now, the Louisiana Legislative Auditor has policies and procedures in place to prevent a local government from doing what is called opinion shopping, or firing an auditor who writes findings in order to find another one who won't write the findings. But a local government generally has broad discretion to hire a CPA firm that they want to hire to perform their audit. It's kind of hard to tell if a local government is truly opinion shopping, or if their auditor is a bad fit and they just want another auditor. And we do generally give the local government discretion. We usually err on the side of the local government because they do have the right to hire the person they want to perform their audit. So auditors don't really write findings because they like to tell people they've done something wrong. The last perception is that auditors are picky and obsessed with the rules like Lewis. I always just thought that he did things like memorize manuals and that type of thing. And the reality is that auditors do tend to be precise and they do tend to follow the rules. However, they're usually generally willing to give people the benefit of the doubt when it is warranted. So auditors don't write findings because they are picky and obsessed with the rules. Given all that, it sounds like auditors don't like findings any more than local governments do. They might affect their bottom line. Hang on a minute. They might affect their bottom line. There might be a bad perception, ill feeling with the agency. And there's many reasons why auditors don't pursue not pursue findings, but don't go looking for findings to write. So why do auditors write findings? The answer to that question is because in some instances they are required to. If your local government provides an audit to the legislative auditor, your audit is performed in accordance with Yellow Book standards or government auditing standards. They're called Yellow Book standards because the original Yellow Book and succeeding Yellow Books had a bright yellow cover, really easy to find in your bookcase. And auditors are required by Yellow Book standards to write findings when certain conditions exist. During the planning phase of a Yellow Book audit, the auditor determines what needs to be tested to give the auditor an assurance or a comfort level, that warm, fuzzy feeling that the financial statement balances are correct so they can render an opinion on them. During the planning phase of a Yellow Book audit, the auditor determines what needs to be tested. Oh, hang on a minute. Need to advance that. The auditor takes into consideration quantitative dollar amount and qualitative, put quantitative price, but that should be qualitative risk factors when they're determining what they need to test. So they decide what they're going to test, they perform tests of the balances, and based on the results of the test, they render an opinion on the financial statements. And I'm sure most of you are familiar with what an opinion looks like. It starts out, the heading is independent auditor's opinion, and it says, I have audited, or we have audited. During a Yellow Book audit, the auditor is also required to perform tests to see if the local government has good internal controls over its processes that affect the amounts that are reported in the financial statements, and if they are in compliance with the provisions of applicable laws and regulations. If the auditor finds that the local government doesn't have good internal controls over its processes or is in noncompliance with provisions of laws, regulations, contracts, or grant agreements, and the amounts in the financial statements may not be materially correct as a result, the auditor is required to write a finding and include it in a report called the Yellow Book report. The auditor takes quantitative and qualitative factors into consideration to plan the tests for internal control and compliance, much like they take those factors into control when they test the balances in the financial statements. Sometimes what an auditor tests is driven by an outside party like a grantor. The federal government sets a lot of the requirements for testing of federal grants, but mostly what the auditor test is based on that auditor's judgment. The auditor performs their test and notes any exceptions, and then the auditor evaluates the exceptions to determine whether they should be reported as findings in the Yellow Book report. Talked about the different kinds of tests that are performed, test of internal control and test of compliance. Those are the two types of tests that are performed in a Yellow Book audit. So there's two types of findings: internal control, findings over the processes, and compliance, findings on noncompliance with laws and regulations. So there's two types of general findings in internal control and compliance, and there's three types of internal control findings. One is the deficiency in internal control. The second is the significant deficiency in internal control, and the third is a material weakness. A deficiency in internal control exists when the design or operation of a control does not allow management or employees in the normal course of performing their assigned functions to prevent or detect and correct misstatements on a timely basis. Those of you who have read a Yellow Book report knows that is the definition of a deficiency in internal control from a Yellow Book report. A deficiency in internal control is a relatively small problem. It may not be necessary for the local government to correct it immediately, but it's a good idea to correct it as soon as possible because small problems tend to grow into big problems. An example, an auditor does the work that they need to do in planning and determines that payroll is quantitatively material to the financial statements. And as most local governments know, payroll may take up 50% of your expenditures. So it's quantitatively material. It's also many times qualitatively material because there's lots of laws and regulations, lots of that pertain to payroll, lots of withholding that has to go to different governments, federal government, state government, pension systems. There's all kinds of laws and regulations pertaining to payroll. So it's not only qualitative material in most cases, it's also quantitatively material. The auditor determines that he's going to test the payroll of 25 of a local government's 100 employees for one pay period. That's going to be their test of payroll. And the auditor identifies the key control as the local government's policies require each employee's supervisor to approve their time card before payroll is processed. So the auditor performs this test and finds that the time card of one employee was not approved by the supervisor. The auditor inquires about the matter and is told that because of an ice storm, the employee's supervisor was not able to get to work on that day that the payroll was processed. And the auditor looks back and finds out, yes, on that day there was an ice storm. It's very pertinent right now. We've had so much cold weather and we've been relatively lucky here down in Baton Rouge, but I know that North Louisiana has not been so lucky. So the auditor determines that that is a legitimate reason for the supervisor not to be there that day. The auditor performs additional tests and finds this was the only time it happened. He might pull, I don't know, several cards more of the employees and determines that this was the only case where the employee's supervisor did not approve the time card. And the local government tells the auditor that because of this was found, they will adopt a policy that would require each supervisor to designate another supervisor to approve time cards in their absence. And I think that's a good plan. Now, given the facts and circumstances, this was brought to me and I was asked, Suzanne, what do you think? What kind of a deficiency is that? Is it a deficiency, a significant deficiency, or a material weakness? I would probably think that was a deficiency in internal control. The condition was isolated. There's a plausible explanation for the occurrence, and the local government has a plan to take care of the problem in the future. As for reporting a deficiency in internal control, there's not a requirement in the Yellow Book to report a deficiency in internal control in the Yellow Book report. The auditor may decide to report it to the local government in a memo. They may do it verbally. They may feel like the notification to the local government when they were trying to resolve the condition or the exception was enough of a notification to the local government. So they've notified the local government, they document it, and they move on. Now, the auditor is not required to report a deficiency in internal control, but if there's numerous related deficiencies in internal control or if other factors are present, such as this caused a misappropriation of funds, the auditor may decide to report this deficiency in the Yellow Book report. A significant deficiency in internal control is a deficiency or a combination of deficiencies in internal control that is less severe than a material weakness, which is something we will get to in a minute, and important enough to merit attention by those charged with governance. A significant deficiency in internal control is a problem that is more serious and systemic than a deficiency in internal control. And left unresolved, it could easily cause a bigger problem. An example, again, the test of payroll. The auditor tests the payroll of 25 of a local government's 100 employees for one pay period and determines again that a key control is the employee's supervisor approves the time cards before payroll is processed. The auditor finds that the time cards of 10 employees were not approved by the supervisors. And the auditor inquires about the matter, and he's told that the payroll clerk, the regular payroll clerk, was absent on the day that the payroll was processed, and that the payroll clerk usually has to remind several supervisors to approve their employees' time cards before payroll can be processed. So the auditor performs additional tests and verifies that each of the employees was paid for the 80 hours documented on their unapproved time cards at their authorized rate of pay, which is good. And the local government tells the auditor that their policy will be strictly adhered to in the future. Now, if I, just on its surface, if this was presented to me, I would say that this might be a significant deficiency in internal control. The condition was not isolated. There were 10 exceptions for this attribute in a population of 25 tested. That's a 40% error rate, exception rate. So the condition was not isolated. It occurred because of a breakdown in a key control, supervisory approval of time cards. And the key control broke down when an employee who doesn't have the primary responsibility for the control was absent. And the person who processed payroll may not have felt comfortable going to a supervisor and saying, you did this wrong. So the supervisor has the primary responsibility for the control, and they just were not following it. A significant deficiency in internal control is required to be reported in the Yellow Book report. The fact that nobody appears to have been paid more money than they were entitled to is not a consideration. And when I was in local government and I talked to local governments quite a bit discussing findings, I would be told, Suzanne, nothing happened. This was a problem. We're going to take care of it, but nobody was paid more money than they were entitled to. But you got to go back to the definition of a significant deficiency, which is a deficiency or a combination of deficiencies in internal control that is less severe than a material weakness, yet important enough to merit attention by those charged with governance. The way to get, if there's a problem, it's a significant problem. I think this would be defined as one. The best way to get the government's attention is to write a finding, have the government respond, and then follow up on it next year. You're not beating up on the government. You just want them to practice good governance. So that's why a significant deficiency should be included in the Yellow Book report. Finally, we have a material weakness in internal control, defined as a deficiency or a combination of deficiencies in internal control, that there is a reasonable possibility that a material misstatement of the entity's financial statements will not be prevented or detected and corrected on a timely basis. A material weakness needs to be corrected immediately. Example, going back to the payroll test, the 25 of the 100 employees for one pay period. The auditor determines that the local government does not have a policy that requires its employees to submit time cards for the employees or for the employees' supervisors to authorize payment for the time the employees work. We hear about a lot of local governments not requiring time cards or employee supervisory approval of time cards. The auditor tests the amount paid to the 25 employees for one pay period and determines that each of the employees was paid for 40 hours. at their authorized rate of pay. The auditor also recalculates each employee's pay for the year and determines that each was paid for the 2,080 hours that somebody would be paid for a normal work year. However, because there are no controls to provide, excuse my voice, assurance to the auditor, that the local government's employees work the amount of hours for which they were paid, the auditor can't be sure if the local government's employees work the 2,080 hours in the year. A material weakness in internal control, if the auditor determines that it is a material weakness in internal control, is required to be reported in the Yellow Book report. The fact that nobody appears to have been paid more than their salary for the year, again, is not a consideration. It's an issue with internal controls. Go back to the definition of a material weakness. It's a deficiency or a combination of deficiencies in internal control, that there is a reasonable possibility that a material misstatement of the entity's financial statements will not be prevented or detected and corrected on a timely basis. Now, the finding classification. How does the auditor determine whether an exception or condition is a deficiency in internal control, a significant deficiency in internal control, or a material weakness? That is largely up to the discretion of the auditor. And I've heard people have told me, well, Suzanne, that's their opinion. And yes, that is their opinion, but they are an auditor. They're familiar with it. They've done more audits, and they have a qualified opinion of the finding classification. Now, matters of noncompliance. Noncompliance with laws, regulations, contracts, and grant agreements that have a direct and material effect on the financial statements. Matters of noncompliance are often the direct result of unresolved deficiencies, significant deficiencies, or material weaknesses. Again, going back to the example of the test of payroll, the payroll of the auditor test 25 of a local government's 100 employees for one pay period. And the auditor determines that the local government has a policy that requires its employees to submit time cards, but does not require supervisor approval of the time card. The local government relies on the payroll clerk to review the amount paid to each employee for reasonableness before the payroll is processed. And the auditor determines that 10 of the employees in the population tested were each paid for 80 hours of overtime during the pay period, a 2-week pay period, so 80 hours of overtime is not reasonable. The auditor inquires into the matter and is told that the payroll clerk was on a leave of absence for 2 months, including the date that the tested payroll was processed. And the person who processed payroll was apparently not familiar enough with the local government's payroll to perform the reasonableness test. Because the regular payroll clerk was absent, the employees were emboldened to request payment for overtime they had not worked. The local government fires the employees and refers the matter to the district attorney. Now, that's bad. That's bad. That's a matter of noncompliance, and it's against the laws of the state of Louisiana, and I would assume most states in the United States. But if it's immaterial, even if it's a matter of noncompliance, say if there were 10 employees and they were overpaid for 80 hours of overtime, and they make $25 an hour, that's $20,000. And that's a lot of money. I would love to have an extra $20,000 in my bank account. But if the local government is a large local government, they have a budget of maybe $50 million. $20,000 is not going to be material to that $50 million. Therefore, they're not really required by the Yellow Book to report that in the Yellow Book report because it is immaterial. However, the legislative auditor has a policy that requires any matter of fraud that is $1,000 or greater be reported as an audit finding. The reason being is that we found a great discrepancy or disparity in how fraud was being reported when I was in local government. Sometimes there would be a significant fraud that was reported, and it was sorry, I lost my train of thought. It was reported as an internal control finding and no mention of the fraud occurring. So we decided that they were going to have to do that. Okay, a recap of why auditors write findings, the different kind. We discussed why auditors write findings, the different kinds of findings, how an auditor decides to include a finding in a report. And now we're going to talk about how to correct common audit findings. And I just got the 15-minute flag, so I know I'm going to have to talk quickly. What I would recommend you do if you get a finding and you just don't know what the first thing is to do to correct it, I would recommend that you do this. I recommend that you read the finding, you talk to the auditor, you develop a corrective action plan, and you implement the corrective action plan. And then after you implement it, I recommend that you monitor it. First, read the finding. Yellow Book findings are required to include the following components: the condition, the criteria, the cause, the effect or the potential effect, and the auditor's recommendation. The finding should theoretically have all the information a local government needs to correct the finding. However, many auditors are not naturally proficient writers, as we said earlier. So what you do then is you talk to the auditor. You ask who, what, when, where, and why questions. Remember, there are no stupid questions. There are usually no stupid questions. And in this instance, there are truly no stupid questions. An auditor would rather spend 20 minutes with the local government explaining how to correct a finding than spend 10 hours writing a repeat finding in the next year. Oh, I'm sorry, I don't need to talk so fast. I was told I have 30 minutes left. Anyway. So I'll talk slower. Again, ask who, when, who, what, when, where, and why questions. An auditor would rather spend 20 minutes with the local government explaining how to correct a finding than spending 10 hours writing a repeat finding in the next year. If they do not want to spend that time with you, I strongly recommend you find another auditor, because that's what auditors should do. And I can't imagine not doing that. I cannot imagine an auditor not being willing to spend time with their client to correct a finding rather than write one in the next year. Now, after you read the finding and after you talk to the auditor to make sure that you understand about what the finding is about, you need to develop a corrective action plan. The corrective action plan should include the corrective actions that will be taken, the person responsible for implementing the corrective action plan, the date by which the corrective action plan will be implemented. Then you need to implement the corrective action plan. You know, to have the plan is great and everything, but then you got to implement it. Sometimes that's and sometimes that's more easier said than done. But then you need to implement the corrective action plan. And then you need to monitor the corrective action plan through to completion and beyond. You don't want a repeat finding. And the reason that you don't want a repeat finding is because the legislature some years ago wrote a law that was written into the audit law, and it implemented the 3 strikes rule. The 3 strikes rule basically says there are consequences to a local government that has the same correctable finding in their audit report for 3 years in a row. You may have to come before, if you have three findings 3 years in a row, the same findings, and we determine that the finding is correctable, you may be asked to come before the Legislative Audit Advisory Council to explain why the finding hasn't been corrected. And then Audit Advisory may ask the state treasurer to withhold funds from the local government. So you really do need to take findings seriously, and you do need to correct them. Generally, it's a good idea to adopt good policies and procedures because people need boundaries. 3-year-olds need boundaries. They need to have a consistent time to get up, to eat breakfast, to take their naps, to go to bed. People, not 3 years old, older than 3 years old still need boundaries. Good policies and procedures are essential when key personnel leave. We hope that key personnel will never leave, but they may be hanging around for a long time, but they may get sick. They may want to take vacation. It's like the payroll clerk who went on leave. The policies and procedures of the supervisors approving the time cards just kind of fell apart when that payroll clerk was gone. Sources for good policies and procedures include the best practices documents on the Legislative Auditor's website. I would also talk with your advocacy agencies like the LMA and the LPJA for municipalities, local governments, the Sheriff's Association. I would also develop relationships with agencies of the same size and type. If you're a village, develop a good working relationship with another village. Ask to see their policies and procedures. Ask how they do something, and you may get some good information from there. Generally speaking, policies should provide for the separation of the custody, authorization, and recording functions as much as possible. Now, there are findings that cannot be fixed, but there are not many of them. One of the findings are findings due to emergencies like fire, flood, hurricane, and pandemics. We've had a really rough 2 years. I'm older than I care to admit, and I've never seen any 2 years in my lifetime where so much has happened, so much bad has happened. Fortunately, in Louisiana, we don't have to deal with fires very much, but we've certainly had our shares of floods, hurricanes, and pandemics. And generally speaking, we have a lot of troubles with floods and hurricanes, and then the pandemic being thrown in on that. It's been a very rough 2 years. If your findings are due to emergencies, if you've lost your records, if you didn't back them up, if you backed them up, but the secondary place where you held them was also in the area that got flooded, you can't fix that finding, but you can go forward. You can have contingency plans to put your records in a safe place, to back them up and put the backup in a safe place. Budget overages. What happens in an audit is that you might have all pretty pristine numbers and a pretty pristine budget to go along with it. This has happened to me before. And then Suzanne, the auditor, comes in and writes all these audit adjustments, and suddenly the budget is just all blown. So that is a very common audit finding, and it's one that the legislative auditor really does, as a whole, doesn't really pay a lot of attention to. Now, if you're not adopting a budget, that's a totally different issue. But as long as this is something that, the auditor came in and just adjusted the books, and you accepted the adjustments, and now your budget's over as a result, we don't look too askance at that. Another finding that you may not have a solution is when your auditor prepares the financial statements. Most local or not most local governments, but many local governments don't have the resources to prepare their own financial statements. And so they contract with their auditor to prepare the financial statements, and there's certain controls in place, and the auditor explains the adjustments to the financial statements, and the agency accepts that it's still their financial statements. But in some instances, the auditor feels like they do need to write a finding in accordance with the standards. There are certain conditions that exist, and they feel like they need to write a finding. The legislative auditor understands that you don't want to spend the money to hire a CPA for your staff if you're a small government, because it may not be the best use of your resources. So if you're doing this, we consider you to be a good steward of your public funds. And that's not an audit finding that we feel like you need to fix. So as long as you're aware of as long as you're aware of what the auditor is doing, and you know enough about it to accept it, we do not consider that to be a finding that needs to be fixed. Now, there is a very common finding that local governments have in their audit report: segregation of duties due to the small staff size. A bigger staff size is often not an option for a small local government, but there are policies in place and procedures that you can put in place to mitigate the situation. As I said before, generally speaking, it's best to separate the custody authority and recording functions of a process. If that is not possible or is cumbersome, there are still things that you can do. One of the simplest things that I can recommend is that the mayor, the director, or the board president, whoever is the CEO of the organization, can receive the unopened bank statement when it comes in the mail and review it before the bank statement is reconciled, before you give it to the clerk to reconcile the bank statement. Now, if you don't know what to look for, talk to your auditor. They'll probably tell you to look for unusual deposits, unusually small deposits, unusually large deposits, checks made out to cash, anything that is unusual, that's what you need to look for. Even better, make a copy of that bank statement before you give it to the clerk and use it to review the reconciliation. If you need an idea of what to look at for reconciliation, in a reconciliation, a bank reconciliation, look on the legislative auditor's website. We have a best practices document called Bank Reconciliations. It can tell you how a bank reconciliation is prepared in a local government and can give you some ideas on what to look for. Now, you can't do much about someone's intentions, but you can do something about the opportunity. Excuse me. Sometimes if it's simple as having a utility clerk, if you have two utility clerks, make sure that they're operating out of different drawers. Make sure that they don't have that if they're going to do something wrong, make sure that they're accountable and they know that they're not going to be able to commingle the funds that both of them are dealing with in the same drawer, so that there's not really any way to determine if somebody's stealing money, who it is that is stealing money. Sometimes just the knowledge that someone is looking over your shoulder is enough to deter some people from doing bad things. Most of us, I think, are intrinsically motivated, have had good parents, good role models, and we're not going to steal anything. But some people just don't. You can't do anything about their intention, but you can do something about their opportunity. There are other low cost and no cost ways to alleviate the risks that are inherent with a small government. Ask your auditor. They'll know your operations better than I do, and they'll be able to give you some ideas on how to do it. Now, findings from a previous administration. New mayors, new sheriffs, people with a 630 year in, local governments like sheriffs and clerks, municipalities with a 630 year in, they'll have a previous administration. And then in November, the new sheriff will be elected and then will be installed in office in January. So the new administration has 6 months of the old administration's transactions that will be in the next year's audit. When I was worked with local government, we would get tons of phone calls every time that there was an election from new mayors, new sheriffs, asking for what is called a cutoff audit. And that would be an audit where the old administration's audit would cut off at the date the new administration took office, because the new administration didn't want anything to do with the old administration's financial transactions. That sounds like a good idea, but it's really not, and I'll tell you why. We really don't like to approve engagements for a cutoff audit. The annual audit is performed on the agency, not the person in the office. It's not performed on the sheriff, it's performed on the sheriff's office. It's not performed on the mayor, it's performed on the village or the town or the city. Now, if a local government has concerns about audit findings from a previous administration, you can engage an auditor to perform what is called an agreed upon procedures engagement that reviews the specific problem area you're concerned about, like travel expenditures, purchasing, that type of thing. However, I'm going to tell you to please be very specific about the scope. Don't let the scope get out of hand. One local government years ago, they decided to do an agreed upon procedures engagement where the auditor came in and looked at every single expenditure transaction for the year. And it was a large local government, and it cost a lot of money. I think it ended up costing $40,000. And there were like 2 little findings. So the moral of that is, be a good steward of public funds. You do need to look and make sure that everything is done correctly. But again, don't be surprised if the results of this type of engagement are not what you think they'll be. If you decide to go ahead and just do the audit, the 630 audit, without doing an agreed upon procedures engagement to check on the things you're concerned about, and there are findings, a perfectly acceptable corrective action plan for a finding that pertains to a previous administration is that the problem will be corrected and it won't happen again, and then do it. Just please do it. And then you will be a hero. So that's a good thing. Now, if you disagree with the finding, you can state your disagreement in your response, but I ask you to keep an open mind. You can call us to discuss a finding that you don't agree with, but I will tell you that the legislative auditor generally does not intervene on behalf of an agency with regards to an audit finding, because the legislative auditor didn't perform the audit. The CPA did, and the CPA is not allowed to substitute the legislative auditor's opinion for his own opinion, because he is the one who rendered the financial statement opinion. So please keep that in mind. Now, resources for correcting findings. We do have a wealth of resources on the legislative auditor's website. This is where it is. It's lla.la.gov. On the website is a whole section for local government entities. It's information for local government agencies, including the best practices documents that I talked about earlier. There's a list of CPAs, the list of approved CPAs and their peer reviews are on the legislative auditor's website. CPAs get audited, auditors get audited, and their audits are called peer reviews. So you can see the results of your auditor's peer review on the legislative auditor's website. Legal FAQs, the legal section of the legislative auditor's website has tons of frequently asked questions documents about budgets, about the public bid law, about good governance in general, and anything you want to know about it. You may just want to spend an hour, look on the legal website, legal page of the legislative auditor's website, and maybe find out something you didn't know before. There is, of course, the Center for Local Government Excellence, which you are participating in right now. Of course, that is a training and certification program. And we also have past workshop participant guides on the Legislative Auditor's website. Then there's the Louisiana Governmental Audit Guide. I feel this is not an old document, but I feel like it's my baby, because about 5 years ago, I took the Louisiana Governmental Audit Guide and I reorganized it and refigured it and put it on the website in modular form. One thing that I wanted to do when I reordered the Louisiana Governmental Audit Guide was it was originally geared more toward auditors, and that was the intent. But I also had spoken so many times to local governments when I was engagement manager that I also wanted to include a section for local governments. So I did. There's a whole list of topics for local governments. There's an engagement completion checklist. I'm not going to read it because I'm obviously losing my voice, but you can see all the different topics in the audit guide for local governments and quasi-public organizations. One of them is findings and management layer comments about what we've talked about today. There's also talks about unresolved findings in the 3 strikes rule. There's contact information on the Legislative Auditor's website. These are the people who you need to talk to if you have questions about your engagements and reports. I'm no longer in local government, so you would need to call Gail or Suda or Tanya or Diane, and they can help you with any problems you have. If you have any questions about the Louisiana Governmental Audit Guide, of course, you can call me, or if you have any questions about this presentation, you could call me. We do have a couple of, I'm just about out of time, and we do have some questions. Lizzie, do you want me to, how do you do this? Yeah, please.
Let's see if I can get through this without coughing. What is the best practice for the number of years that the same auditing firm be engaged for the public body to perform the annual audits?
That is a really, really, really good question. The Legislative Auditor's Office does not currently have a policy for that, not for local government. We know that a lot of people, a lot of local governments, they're with the same CPA firm for a long time and they feel comfortable with them. And they don't want to change it up. And we, generally speaking, don't require them to change it up. There's nothing in the audit law that requires that a CPA firm only audit like 5 or 6 years. But it is a best practice to change up audit firms every few years. Sometimes what happens is that a CPA firm will go from the auditor to the advisor capacity and doing things that the independent standards are not going to allow them to do as the auditor, and then may come back in a few years. But there's not a best practice that I'm aware of. I would recommend bidding out, maybe as an alternative, maybe bidding out your audit services every 5 to 6 years, rather than say, okay, now we have to have another auditor because it's 5, 6 years. It also would be a very good idea if you had an audit contract with a large firm to see if they will swap out partners every so often. That way, a new set of eyes will look at the work that's being done, and that's never a bad thing. We have multi-layered reviews in the Legislative Auditor's Office, and sometimes people say, well, that's an awful lot of review, but I personally am very happy about the level of review that we have at the office. it gives you a good comfort feeling to know that so many people are looking at something before it goes out the door.
Next question. If your audit firm changes owners or partners, does that count as changing audit firms?
Well, going back to, this is interesting that there were two questions on the same topic. I think it would depend on the personnel assigned to the audit. I don't really know that the audit firm is as important as the persons who do your audit. You, like I said earlier, I think it's generally speaking to have a good, it's good to have a fresh set of eyes doing your work. And so I don't know if it counts, but it's not a bad idea. Even to have auditors, or what happens in most firms is that if they have several layers, they'll have the partner, a partner or partners, they'll have seniors, and then they'll have staff. And the staff kind of rotates in and out. And the seniors tend to do most of the work, and then the partner reviews the work. If the seniors rotate out and then the partner stays the same, that's one thing. But then if the partner rotates out, I think, generally speaking, I just think it's a good idea for different eyes to be on an audit in subsequent years. I think that's just generally a good practice to have. Are there any more?
Final question. Do salary employees need to turn in timesheets?
I have worked for the Legislative Auditor's Office for almost 31 years, and I have always turned in a timesheet. And I just think it's a good best practice. I'm salaried, but a timesheet forces me to sit down every other week and tell my supervisor, Diane Allison, who's sitting next to me, that no, I was not in the break room. I was actually working on quality control reviews, and I was working on the Louisiana Governmental Audit Guide. I was not in the break room drinking coffee. And then Diane, who sees me and knows that I don't spend all my days in the break room. It's, yeah, salaried employees have some latitude, but I think you still need to be accountable for public funds. I cannot think of a good reason why you would not want a salaried employee to submit a timesheet.
To piggyback on that, can salaried employees be required to punch a time clock?
That's a legal question. I don't know. I don't know the answer to that question. You might want to ask your legal counsel about that. But again, I don't see why not being an attorney. But I don't think controls are a bad thing. I just don't think they are. Okay. All right. Well, I'm getting close to 45, close to the hour. And I do thank you for listening to me and my froggy voice. I think we all have, I think every single one of us in this room that I'm sitting in, we have all had allergy problems today. So at any rate, thank you very much. Again, if you have any questions, please do not hesitate to call me.